it has built up some investor base over the last few weeks and months here. I want to bring in Alan Nuckman, Chief Market Strategist at Bullseye Option. Great to have you with us, Alan. So much to talk about. Thanks for being here. So let's just start within this kind of question of rotation, which, when you look at the very, very long-term charts, you want to hesitate to call it too soon, because ultimately the story has been, right, big tech is going to lead small cap. That's just been the story for 20 years, as we were just talking to Cameron Kreis at Bloomberg about. Are we at a pivot point? Are we at a point where you say, the Russell 2000 might actually start to outperform the NDX?
We'll have to see, but I'm very encouraged by the way that you're seeing the laggards now turn back into the leaders. So you're seeing that rotation. You're seeing better value, people going after the stocks that have better risk reward, and that's a very healthy sign that they play catch up. Now, today we have to talk about the Dow. The Dow is not a great indicator of the market, but today's a 30,000 Dow day. So we have to talk about that. It's only up 5% on the year, whereas, the other indexes have been much stronger. But that's positive. You're seeing that catch up in the Dow. The Dow's only 30 stocks. And what I really like here is it's doing it without Apple. Apple obviously had been all about Apple. That had moved the market, and it's kind of stalled for now. But if you look at the Dow, 10 of the 30 Dow components are actually essentially unchanged or negative over the last 52 weeks. So you've got some big names that could do some, big things. You could look at Intel, IBM, JP Morgan, Merck, Cisco, Amgen, American Express, Coca-Cola, and CVS and Boeing. So there's a lot of potential there to carry that sector. But I'm very encouraged by some of these stocks that have been left behind making a big day today.
So, and let's just stay with the Dow for a moment, because there's lots of debate, and certainly some of our viewers feel strongly about the place it should hold. I don't have a Dow 5000 cap, but I could have got one if I bothered, back there pre-tech bubble. We've seen the pace of the increase in this very narrow gauge pick up, and to your point, it's it took a while for it to fully participate in the most recent rally. Why should we still watch it at all? Why is the Dow something that you'll keep an eye on here?
You really shouldn't. When we talk about the markets as professionals, we talk about the S&P. The S&P is the barometer, is the gauge. Now, the S&P has been stuck between 3,200 and 3,600 for the longest time, and now it's broken above 3,600, so that target's 4,000. But it's on days like today that you want to just take a cursory glance at the Dow, and the fact of those stocks, which are all big names, still have a lot more room to go is very encouraging, because those are stocks that everybody knows, that everybody follows. The S&P is the scorecard. That's what we use. And the most encouraging thing that I've seen in the last couple of weeks is not this new high in the S&P, not this new high in the Dow. It's the fact that energy had that breakout. Now, the XLE, which is the energy ETF, that's the biggest news. We had that 17% move a couple weeks ago, the biggest weekly move since they've been keeping records since 1989 in XLE. That sector, those stocks have suffered so badly. Obviously, we're dealing with Canada here. You're very familiar with the energy sector not participating in this market rally. So that's a very healthy sign that you're seeing that sector, because that's the next catalyst for the market. The market is essentially doing this without the big tech names. We haven't had a tech takeoff. We haven't had a new high in tech when you look at the NDX top 100. So when that happens, then this is going to be hitting on all cylinders. You're going to see these markets go, go, go. But I'm so encouraged by the energy sector in this comeback.
So, and I want to stick with that for a moment, because we're also watching the commodity price itself, right? Because it's a little less emotional. It's a little more professionally traded. No Robinhood traders on West Texas. And it is hitting this kind of new summertime breakout, if I can put it that way. We're not back to where we were in January, but this feels important to me, Alan. Are we right to say the globe is kind of pricing in, the smart money is pricing in reopening here?
Yeah, that's what we've been waiting to see, and waiting and waiting and waiting. As a trader, I've been so disappointed in the fact that crude oil has been stalled for so long. Now, that means eventually there's going to be a big breakout, and that's maybe what we're seeing here. So we've been in a big range, let's just say between 35 and 45 for many months, and let's see if it can break out to the upside here. But there's so many things that are positive. Obviously, number one, the rest of the market. And in the last years, we've been seeing the crude market follow the stock market, because it's kind of a barometer of economic growth until we had this disconnect recently. So this is positive. We need to build on it. We could very easily be at $50 very quickly in crude with this pent up energy that's in the chart, that's in the crude oil itself. So let's see what the next leg. The next leg, I think, can be determinative by what happens with the dollar. The dollar is such a big deal. The U.S. dollar is heading down, and it's down to the 92 level, which is a super support level. If it breaks this, it can test those lows. That'll be another catalyst. Let's remember that it doesn't matter who's in Washington. They have a weaker dollar and lower interest rates in their best interest to stimulate, and that's what people want to see.
So let's go back to this thought that you've expressed here. We see the rotation. We see some of those laggards picking up. As you put it, when we see the NASDAQ 100, the big techs that got us here, right, also hitting new highs, that's all cylinders. Would that be a rocket to the moon? Is that a safe place to be, Alan, based on fundamentals?
Well, you've already seen some exhaustive moves and some big plays. But to get back to something like Apple, Apple is still 20% off its high, so it's still at a discount. So from that standpoint, risk reward, maybe it's 10% off its high, sorry. But even at that, if you don't want to buy Apple at a 10% discount, when would you actually want to buy it? They made more money in the last quarter than most companies make in a decade of pure profit. So to question that, I think, is a fool's errand. So, there are some plays, but it comes back to your risk tolerance. Are you someone that wants to buy value and look for it to catch up? Or do you want to buy the momentum movers and look for it to continue to go? The NDX is 75% off of its lows from March. So it's already come a long ways. Not to say it can't go a long ways further. People have been trying to pick a top and a turn in this bull market for a decade now. Every single time we've seen a sell-off, it's bounced right back, and it's bounced the distance of that drop from the top on those old highs. So there's a lot more upside, about 8 to 10% here when you look at the NDX and here when you look at the S&P. So, it's there, but let's understand that any time there could be some profit-taking unwind, short-lived, but you've got to be able to understand your personality profile to understand the risk and your long-term convictions.
Okay, I want to hang on a couple of points here, and starting with the techs, just a little bit of a contrarian pushback on valuation. I mean, yes, Apple could hit new highs from here, but its PE is 35, forward PE just below 30. That's pricey, is it not? Or we're going to give it to them because do we think they're recession-proof? I guess is one big question.
I would think that Apple, not to say anything can't happen to any stock at any time. Obviously, we saw Boeing was a high flyer for the longest time, and then it had things out of its control that brought that stock down to earth. But Apple is its own animal. And to get back to the Dow, the Dow, the reason we don't like it as an indicator, as an index, is because it's priced based upon share price, not based on market capitalization. So it's not a fair barometer. But to get back to Apple, I mean, Apple's America. I mean, either you believe in the market or you don't. And so that's how I would view a place in Apple. But if we were going to get into some of the valuations, you could say that Tesla, or you could say that Amazon for many, 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 many years had an extreme valuation and still does. So, valuations just like price can always
90 PE for Amazon.
Right. Your valuations like price can still go higher than you think. And it's just a matter of you don't want to be the last person to buy the stock. You want to make sure that there's someone above you that wants those shares more than you do.
I think we call that the final fool, don't we? No, I'm just joking. I do want to. We're going to run out of time. I want to ask you one quick question. It's a bit of a technical one on oil, but I just want to make sure, because we've seen the futures market play a big role in the price of oil this year, right? Remember back in the spring where we went negative. Is the top we're seeing, because we saw it. I'm just wondering whether this is related to the contract expiration, which I think just happened Friday, right?
Right. So the oil play, the problems that we had in oil had to completely do with expiration. Those people who were trading at that particular time shouldn't have been in it. Brokerages force you out of your positions going into that. No one wants to deal with the cash. That was a strange aberration that had nothing to do with the actual real value. That was just a one-day glitch, and you can see how quickly the markets corrected themselves way back in the spring. But that was a complete capitulation. That's the worst we've ever seen in oil, and it's been straight up since that time. So use it as a barometer right now. I look at it very much positive. The last thing I want to say is sometimes it's not what the markets are doing that's important. It's what the markets aren't doing. What we've been through in the last year, it's been I don't even want to use the word amazing, but it's unfathomable. And the fact is we're up here at these new highs, and the VIX is down here at the 20 level. The dollar's down. Everything is showing signs of stability and strength. That is a positive more than anything else that's happened so